Hey, welcome back to Harvesting Income. Today we're going to talk about a popular covered call ETF, which is known as XYLD. XYLD is the ticker symbol, and this is also known as the S&P 500 covered call exchange traded fund. Let's look at different aspects of this fund and see, what are the pros and cons. Um, First, let's try to understand what they're trying to do here. Basically, the fund is known as the Global X S&P 500 Covered Call ETF. So Global X is the fund manager, and they are part of the Mirae Asset Management Group. And looking at the objective, we can see that the fund seeks to provide investment results that are corresponding to the price and yield performance of the S&P 500 buy right index. So basically, they are following CBOE S&P 500 buy right index, which is also known as the covered call writing index. And what they basically do is they buy all the stocks which are part of the S&P 500. The fund buys the stocks in all the index constituents, or all the 500 stocks which are part of the index. And then to generate income, they will write or sell index call options. Basically, they will write or sell the S&P 500 call options. So I'll explain to you that when we look at the holdings, shortly. And this fund is able to generate distribution of 9.6%. So if I do a quick calculation here, so 9.6% a year would be about 0.8% per month. So that's the yield you can expect roughly, but it can go higher or lower. This is not a guaranteed distribution. Like, it could be slightly higher, slightly lower, or much higher, much lower. We never know. Uh, let's look at the distribution history. When you look at the history, we see that in January 2024, this year, the beginning of this year, they paid about 31 cents, and then February 30 cents, then March 32, 34, and May dipped a bit, 28 cents. June again dipped a bit, 27 cents. And again July 31, August 40, and September 34 cents. So basically, they are in the range of high 20s to, you know, mid 30s, like high 20 cents and mid 30 cents range. Probably the average would be somewhere around, you know, 32 cents or so. In August, you see that there is a higher amount of dividend. Probably it's due to the high volatility, but this may not sustain every month. It's not guaranteed. It all depends on how the markets function and how the fund manager is able to generate income from the covered calls. Okay. Okay, with that cleared up, now we can go to the holdings and see what it is made up of. Basically, they hold all the top 500 companies, as I mentioned, in the 500 companies of the S&P 500. That covers all the entire US market, all the big corporations across industries, across sectors. You name it, and you have all these big brand names: Apple, Nvidia, Microsoft, Amazon, Berkshire. And if you go further down, you have all these JP Morgan, ExxonMobil, Tesla, United Health. I mean, all are blue chip companies mostly. You rarely find any smaller names here. All are well known names, have had presence in the industry for about, probably several decades or several, eras or centuries. Like, these companies have been there for a long time, and they have a bigger impact on the overall economy. And they also have a short position, basically the call writing position on the index at 5855. So that is how they are generating the income, by selling those calls, which means the upside is actually limited in these funds. So one key factor to remember is, whenever there is a covered call writing in the ETF, they basically do that and generate short term profits. Basically, they're giving you the slice of those profits which they generate every week or every day, depending on the type of calls they write. And they give those small slices of profit to you every month or every week. Due to that, you may not see much of a capital appreciation because you're already, encashing those gains in the form of dividends. So that's how it works. I'll just quickly open the fact sheet to show how it is performed. This fact sheet, which is about August 31st, a little dated, but still a good reference point to look at. You can see here under the performance that they have been pretty much consistent and they have been performing in line with the index. Uh, they might be underperforming the index because covered call funds would have a limited upside. So you will see a minor, you know, dip in the performance compared to index because of the fees and costs and various other factors. But it would be pretty close mirroring the index trends. And they have assets under management of 2.8 billion. Expense ratio is 0.6%, which is quite reasonable for a covered call ETF. And yield is about 9.6%. We already discussed that. So, and they're paying every month. So you are getting a good amount of cash flows every month. You can see the yield is like going up and down, but probably close to the high 20s or low 30s range. And you can look at the sector breakdown, like it basically replicates the S&P sector breakdown. Information technology and financials, that's the major chunk of it. And you also have healthcare, consumer discretionary, and communication services, diversifying into various other sectors. And this would be exactly similar to the overall S&P 500 index. Okay, now let's go back based on what we see in the trend here. So basically they're saying 9.6%. So imagine you are investing about $1,000 in this fund. So in a year you'll be making, you know 1000 times 0.096, $96. That would be $8 a month. So if you are putting in $1,000, you're able to get eight $8 a month. This would be the dividends or distribution roughly based on what is quoted here. And apart from that, you also get a capital appreciation. So the appreciation roughly in the last, let's look at the 1 year returns. The last 1 year is about 17.5%. This would change year to year, like, so. So you are getting about $8 per month in the form of dividends, around 9.6% plus another 6-7% capital appreciation, which will be like total about 16-17% a year, adding both the capital appreciation plus the dividends together, like, which is a very good performance. Like if you're getting something in the teens, like 15-16% a year, that's wonderful. The dividend yield may be inconsistent, like it can go up and down depending on the market volatility and how the fund writes those calls. And when the market is a little flat or slow or down, you get more of these income, and the fund outperforms the market. But when the market is very bullish and everything goes well and the market is steadily going up for a long period of time, that's when the covered call ETF is going to underperform, and you will see that they underperform the index. That's what is happening over the last 1 year. Index has been giving 18.3%, fund is giving about 17.5%. There is a bit of underperformance, but you still get some performance. You're not losing money. So for an income investor, this is a wonderful option to consider. Not a financial advice, but this is one of the funds that you can look at. There are many funds in this space, in the covered call ETF space, and many other options too. And as an income investor, you can look at these type of funds, and this is one example. And if you're able to consistently generate that income every month and you're able to reinvest back into the fund or reinvest in other areas, you're able to grow your income and also build wealth over time. So I hope you like this video, and I would look forward to your comments and your feedback on this special segment where we are covering each and every fund and reviewing them. Please drop in your feedback and comments below. And if you like what you're watching, please subscribe to this channel and share it with your friends and family and people around you. Thank you. Back here.